Wow, there have been so many changes in the housing market in the last few years, with interest rates rising and house prices going crazy. And now maybe you've seen in the last few months some of those headlines that say Biden wants to punish you for a good credit score, and you're left just wondering what is going on. Well, if that is you, you have come to the right place, because I have Matt with Flathead Valley Mortgage here today, and he is going to help us break it all down and translate what it means for us in the home buying process. I am Janet with Radiant Realty, your Montana realtor. Thank you so much for joining me. If you are new to the channel, hit that subscribe button and stay a while. Don't be shy. I love reading your comments and answering any questions you have. And if you are looking to buy or sell a property or home here in Montana, definitely reach out. I would love to hear more about your needs and answer any questions that you have.
Hi, I'm Matt Rislow with Flathead Valley Mortgage, and yeah, let's talk about the FHFA line level pricing adjustment changes that have recently happened. So there was definitely some confusion when these came out. A lot of people thought, and even some articles online were written, that if you had a worse credit score that you were going to get a better interest rate, and that we were subsidizing less qualified borrowers with higher qualified borrowers and they were suffering. So it's not really the case, and we'll kind of break it down a little bit. So what is a line level pricing adjustment? Line level pricing adjustment, simply put, is if you have the perfect borrower, putting 50% down, 800 credit score, that person's going to get the best rate possible. And then any further away you get from the highest down payment or highest credit score, there's going to be pricing adjustments where you're going to pay more for the same rate or take a worse rate. Before, it was a pretty linear scale, and now there's been some slight tweaks and adjustments. A person with a 640 credit score compared to a person with a 740 credit score, they're not going to get the same rate. 640 is still getting a much worse rate than 740. The difference, though, with those changes is that the 640 credit score person is being punished less. The change is way less drastic than it used to be. There is a weird little sweet spot with these new changes where if a client is putting like 20% down and they're between 700 and 740, they're going to get worse terms than they were getting before the changes. So it doesn't really have anything to do with the person next to them. It's just that single profile. It's a little less efficient at that range. They will actually get slightly better pricing by putting less down. And that seems a little counterintuitive sometimes, but the main thing with that is that if you put less than 20% down, there's now mandatory mortgage insurance on that product, and the loan is insured, which means it's actually less risky for a bank. So in the grand scheme of things, don't tank your credit score or do anything like that thinking you're going to get a better rate. Always work on having the best situation possible, but there might be a weird scenario where it might be better to put 5% down instead of 10% down. Maybe, but that's something that you'll want to talk to a loan person with, loan officer, and make sure that you have all the information before you make that decision. One thing that already got repealed is there was some pushback with these changes, and I don't particularly like the changes myself, just kind of punishing that mid-range down payment borrower and credit score borrower. The one change that got already repealed was there used to be a bigger pricing hit for people who were borrowing more against their income, or a debt to income ratio. So there was this weird threshold at 40% where if you were over that, then you were going to get hit with a bigger fee. Well, that was really hard because sometimes you can't hash out someone's income perfectly during the pre-approval process. So we might be misquoting someone a rate, and then all of a sudden they go through underwriting and they're going to have a worse rate. So that was actually really quickly repealed because it was hard to calculate, it was hard to account for, and we want to be able to be as clear and concise with clients when we're giving them a rate quote. And one other change that did happen, not just with that sweet spot and stuff, the pricing adjustments for conventional loans now go on credit score. They used to stop at 740, and 740 and up was perfect. There are a few more pricing adjustments all the way up to 780. So that means that someone who has a 780 is going to get a little bit better pricing compared to a 760 or 740. So that can be a good or a bad thing in that sense. Another really interesting part about all this is we have a lot of clients that were saying that were frustrated that they worked hard on their credit and now they're getting a worse rate. We debunked that, and they're talking about how people with lower credit scores, they're going to get better terms now. They're just going to get better terms than what they were getting before, still technically worse terms, better qualified borrower. But another change that actually happened is that FHA mortgage insurance rates were recently lowered, which means those clients that are 680 and under, they're almost always going to benefit from going to an FHA loan, and it has become a much more enticing product than it was even a year ago. So even after all of these broad changes, really, there's just more options for borrowers out there to get qualified and enter into being a homeowner. So there's always a big question, what are interest rates doing, right? Well, nobody has a crystal ball, so everything's always speculative, and there are some big market indicators that can help us make a very educated guess, but nobody should be banking on what rates are going to do a few months from now or a year from now. With what's going on, inflation is kind of tapered off. The Fed has come and announced and said what rate hikes they're going to be doing in the near future and that they're going to be stopping and eventually lowering them. We think that rates are going to be fairly stable throughout the end of the year. We might see a slight drop, we might see a slight rise. Nothing that's going to be significant or should make any home buying decisions going on right there. And we believe that there's probably going to be a refinance window for pretty much anyone who bought a home in the past year and a half in the next 18 to 24 months. I think that'll be a very good opportunity to get rates back into the 4s to 5s. We don't think we're going to see 3s or 2s in a very long time because there were some crazy market factors at play that we don't foresee happening in the near future.
Wow, thank you so much, Matt. That was so helpful. I hope that was helpful for you. If you have further questions, I am going to leave Matt's contact info in the description box below, so be sure to check that out. As always, you can feel free to call me anytime as well at 406-890-5390. Have an amazing week, and I will see you next time.